Yeah, although the issue still remains, it's too volatile to use as money per se. But what it does do very well is protects against the outcomes, which are more central bank printing. It's madness out there. And this just shows the mess that we're in and the value of why digital assets. And I'm just looking at this again, thinking, well, the US is doing exactly the same thing. Once it feels its monetary system is under threat, it tries to shut down the borders and everybody just moves over to London. And I guess we would see that by a lack of growth of the ecosystem in this next cycle, let's call it that. So if we're not seeing adoption grow at the rates that doesn't have to be of past cycles, but if it's disappointing in its growth, then we've got questions to ask. I never forget, I first got into Bitcoin having gone through exactly this in the European crisis, 2012, and realizing that there were no bearer assets and your money was not a bearer asset either. And that's when I discovered Bitcoin. And here it is in the United States playing out, and Europe as well, with Credit Suisse going under, with people starting to realize the true value of what this is all about. Yeah, although the issue still remains, it's too volatile to use as money per se. But what it does do very well is protects against the outcomes, which are more central bank printing. It does a very good job with that. It obviously didn't do a very good job with regular kind of supply demand led inflation, but it does an extremely good job every time the balance sheet expands. And I've always thought of Bitcoin as a call option on a future financial system. It's like, the probability of it being in the money every time you see instance like this goes up, which is, exactly to your point. As soon as you see more outcomes that devalues money overall, the more probability that Bitcoin has a much higher value in the future or a much larger role to play. And we're certainly seeing that. I think, another big thing that I think played really into the Bitcoin narrative, which is still probably a bit misunderstood, was shutting Russia out of the SWIFT payment system and saying that all of the treasuries they hold are basically worthless.
Yeah.
So we've seen record central bank buying of gold, and we know that several central banks have been, or central banks or sovereign wealth funds have been acquiring Bitcoin because in this world, they need something like this, a true bearer asset.
For sure.
We've all been monitoring the debt ceiling, and it looks like it's going to come down to something like 2011, where it got to the wire. And a lot of people are suggesting maybe this time is worse, and there is going to be a technical default of sort. Janet Yellen's given us the kind of dead date by about the 1st of June. Others suggest maybe it's July because there's some delayed tax payments to California to come through. But I just can't help but think that is incredibly positive for Bitcoin if you see anything close to a potential default. Because it creates, as you said, a complete lack of trust of the system, because you can't price any financial instrument at that point. But again, this whole shenanigan, regardless of how it goes, just shows the problem of the existing system. There is no real way out. Yep. The only real way out is run negative real rates or debasement of currency ongoing.
Yep.
Yeah, and the next shoe to drop is a longer term one, which is, yes, right now with the inverted yield curve and everything else, it's a nightmare, and we'll probably see more banks go under. At time of chatting, yesterday was another ugly day in the banks, and doesn't feel like it's going away yet until the Fed cut and steepen the yield curve. But we've still got this issue of commercial real estate stuck on these banks as well. And that's a long overhang that's not going away. So few people actually go to the office anymore. I went to a big asset management firm in New York's office last week. It probably seats 400 people. There's probably 20 people in the office. And they're like, oh, yeah, well, people come in 2 days a week. I'm like, yeah, but you don't need a 400-person office.
Exactly.
We kind of saw it in Europe, and it ended up on the ECB balance sheet. They basically took any old shit as collateral. Old chewing gum wrappers, old cigarette boxes, anything. And they said, we'll lend you against anything. And we saw that in Europe. And I think it's just the same outcome. And there's no other way around it apart from to shove it on the central bank balance sheet, because if not, the whole banking system is insolvent and there's no lending left. I look at liquidity as probably the biggest driver of asset prices because of, I think, this debasement mechanism. And, we build a liquidity indicator at Global Macro Investor, and the NASDAQ is 97.5% correlated since 2010, and Bitcoin is 87.5% correlated. And it's only lower because Bitcoin has the exponentiality every time you get a bull market. But, that's staggering.
Yeah.
They didn't use the balance sheet. So then you had M2, but M2 is actually the predominant driver of earnings as opposed to price. So the whole world changed in 2008 as everybody reset interest rates at zero. The entire world did. And so you've got this very cyclical cycle that actually matches the Bitcoin cycle because Bitcoin was birthed at the same moment. Everything's got an identical cycle, which is basically the global government's debt refi cycle. And it's between their 2-year bonds and their 5-year bonds that creates this 3.5-year magical cycle. And so that is what changed everything. And then what we found is every time we get to the lower part of the cycle, the interest payments, and I mathematically worked this out, the interest payments for that period of 3.5 years ends up being the amount of QE. It's almost perfect. The only difference is when they have to intervene directly into the banking system because that goes direct onto the bank balance sheet. So they're just monetizing the interest payments of the government, and they're all doing it. So I backed out all the maths. The Japanese started it first, obviously. I think the whole accord came together in 2012 when Europe went under. But it's Europe, Japan, the US, the UK, Switzerland. It's all the same. They're all doing the same thing. So it's like, oh, wow. So they're just monetizing the interest payments. It's madness out there. And this just shows the mess that we're in and the value of why digital assets. And I went back and looked at the history of London as a financial center post the rise of the US as the world reserve currency. And after they left the gold standard, the US had currency restrictions. So the UK started the global FX market. Because before then, there was no FX market, right? Because it was all pinned to gold. London already had the gold market. So then they bring the FX market. It becomes the biggest market the world has ever seen. Then the US restricts liquidity to the global system. The UK develops the Eurodollar market. So the Eurodollar market grows out the 70s and explodes in the 80s and 90s. And then the next part of the equation was the global derivative market. The US regulated the banking system and didn't give them reg cap abilities to use OTC derivatives. So London took it and exploded, which is why most of us worked part of our careers in London. Half the hedge funds in the world were based in London. And I'm just looking at this again, thinking, well, the US is doing exactly the same thing. Once it feels its monetary system is under threat, it tries to shut down the borders and everybody just moves over to London. Or, it's most likely to be London. And then you have the off centres of Singapore, Hong Kong, other European centres. So it's just, as you said, you can't stamp this out. This is a global phenomenon. It's a cockroach, and you can't kill it. Why the UK works, it's so easy for Coinbase to relocate to London because everybody speaks English. It's a rule of law. It's a very understandable culture that everybody's familiar with. It's no great shakes. If you went to half the staff at Coinbase said, "Hey, do you fancy a 3-year stint in London?" They'll take it. The other issue the industry, I think, still faces is the concentration risk of the derivative markets at Binance. It's like 70% of the entire marketplace. Now, it's good. Coinbase is set up now, setting up, and there's a few others, but there's a big gaping hole still after FTX. Having been, I grew up in the derivative market, and I look at this, and you see an asset that people want to own, and you see it has a yield, and the volatility is pretty much at its low. So you get the ability to take the yield and buy options. And so you can create guaranteed products or defined risk products or enhanced return products, which was the explosion in the European derivative markets and the Asian derivative markets in the 90s onwards. And I kind of rode part of that wave. And I look at it now and I'm like, in 3 years' time or 2 years' time or 1 year's time, we'll see a ton of these things, 80% guaranteed funds, 90% guaranteed funds or accelerator funds, all of that stuff. To go on back to Bitcoin, there's another change that's happened, which is ordinals. How are you thinking through that? The Bitcoin community was completely split by, what? You're using it not for ultrasound money where it's the hallowed ground, and now people are trading JPEGs on it. Solana's been a great story from it's completely dead to, one of the best performing assets this year. In the end, it's about network adoption. The technology, there's some limits to what we actually need. There'll be some that will have a technological breakthrough and it becomes easier to, let's say, put video files on chain or whatever. Okay, fine. There'll be a niche for that, but I think you're right. Looking, I personally think that we're in crypto spring right now, and we can just continue. It usually is a bit choppy first, and then it gets very interesting next year. When you're looking forward, what are the kinds of areas of activity do you think we're going to see a resurgence of? Obviously, we've talked about DeFi, and you think there's opportunities there. And actually, the collapse from last summer will have caused more money to be invested into DeFi and solving some of these problems. What else? NFTs feels like it needs a new change of narrative. And that whole rise of Web3 loyalty programs, using NFTs as a structure, an architecture to do that, I think is, I still speak to a lot of big brands and they're not fazed by anything that's happened. All they're seeing is I can get closer to my customer, I can cut out middlemen, and I can create loyalty. Final question for you. I mean, we're both bullish of this space by nature, so that's not helping anybody really. Anything you see on the radar screen that is an underpriced risk? I mean, there's a lot of risks we all know about, but is there anything you think, people should just pay a little more attention to that? My upside risk is ETH staking plus burning. Mm-hmm. Means that there's, in a bull market, you might end up with no supply, which is, I think, could be a real problem. And I think options, way out of the money options next year, probably wildly mispriced. And the other risk to me is the big Binance option, because the derivative market, if that goes, it takes a while before hedge funds and other participants can spin up new counterparts to absorb it. And I guess we would see that by a lack of growth of the ecosystem in this next cycle, let's call it that. So if we're not seeing adoption grow at the rates that doesn't have to be of past cycles, but if it's disappointing in its growth, then we've got questions to ask.